That's the best performing stock from our top 10 list, suggesting a gain of almost 7-8% right now. Okay, let's start with the large caps then. 20 points higher, but then 8 points up. It's flashing. Not quite settled. Now 20 points lower, 18 points lower. So it's a little all over the place. Bit of a volatile start, you'd have to say. So let's see where the pressure is coming in from and what IT is doing. It is indeed IT, which is keeping the bulls in check this morning. HCL Tech about 0.7% lower. Wipro is down by about, again, 0.7%. Infi down by about 0.6%. TCS is down by about 0.3%. So cautious start for IT. What else is down? I can see Nestle towards the end of the Nifty tally. Sun Pharma is also marginally lower. Large banks like HDFC Bank and ICICI Bank flat to slightly negative right now. So you have a lot of red, you'd have to say. Look at that. Almost 3 lines of red on the heat map. On the green side, Coal India, the news that Sud spoke about, the fact that they're looking to bring more of their subsidiaries to the market, listings for many of them, including Southeastern Coalfields. That stock's up about 1.5%. Shriram Finance continues its forward march. Gains now touching 67-68% for the full year. Axis Bank is defying the weakness in some of the other large cap banks. That one's positive. There's a bit of a shine on Hindalco, but then the good news for the Nifty pretty much ends there. We have started and we're settling with about a 20 to 25 point cut on the large cap index. What about mid caps?
Caps are more resilient than the large caps, one has to say, and it's a lot of the commodities names which are doing a lot better. So we have Hindustan Copper, Hinzinc. Remember, it was a big rally that we saw in silver, $72 an ounce on silver as well. So Hinzinc benefits from that, up around 1.5%. We are seeing some traction, as Horma's pointed out, in a couple of these rail names as well. So IRFC, RVNL, both of them fairly well bid in trade. In particular, a stock that we don't often speak about, JD Cables, is one of the bigger gainers. It was up around 7-8% in pre-open as well, but now is higher. It's got an order worth around 244 crores. Then we do have Endurance, which is marginally lower on the cybersecurity incident that took place. United Spirits marginally lower, Patanjali Foods lower as well. And we do have Omax, which is up around 6% after seeing a 20% gain yesterday. So big volumes picking up on that counter. And Yatra Online, as we move towards the end of the year, all these holiday-related stocks start doing well. And Yatra Online is one of them, which is up around 5% too. So mid-caps now back in the green, a lot more resilient than, say, the frontline index, which too has been flitting between red and green.
Well, let's just get to some of these new age companies. So Pinevala is one where Jefferies initiated coverage, target price 300. It had a good listing. We'll just let the rate come in on that. PhysicsWala is the other one where Goldman Sachs has initiated coverage, but here they have a neutral call on PhysicsWala. Their target price is 135. And the other one from the new age companies is LG Electronics. Investec has initiated coverage with a reduce. Their target price is 1,536. We spoke to Sathvik Green, and that stock has opened up mildly in the green, 1.5% up. And in the mid-cap IT pack, Coforge continues to see some amount of selling pressure ahead of the board meet on Friday, where they will consider a fundraise. So H1B overhang aside, here there is that fundraise announcement on Friday. So there could be that dilution risk. So that's putting a bit of pressure. But other mid-cap IT too, mildly lower. Birla Soft persistent, down about 0.5%.
And I was watching that announcement from Coforge and I was wondering, they've chosen such an interesting date, right? 26th, 5:30 p.m. and people are just about getting into holiday, if not holiday, at least weekend mode. But
really no holiday for the board of Coforge.
No, clearly not. Okay. All right. Let's take the conversation forward. Manish Sonthalia is joining in. He's our market master of the day. Manish, thanks so much. Human beings are optimistic creatures by nature, and more so if you play in the capital markets. You have to believe that the coming year is going to be better, right? So we start right there. But beyond the well-placed optimism, if you really look at the facts on the ground, valuations, if you look at how India needs to compete with other markets, we're not, an isolated story. It is a connected world. Realistically speaking, do you think that this sluggishness of 25 will finally end as the year comes to a close?
Yeah, good morning, Surbhi. Yeah, I do believe that probably you would have seen the worst in calendar year 25, and more so on account of the Indian rupee, which has been falling relentlessly. 91 is overdone, according to me. And, even the earnings trajectory would seem better going forward. Of course, Q3, we are looking at something like 9% revenue growth and maybe slightly lesser than that on the PAT front. But come FY27, things should look better, more on account of government impetus, and earnings should be around 13-14%. Suffice it to say, valuations are not very expensive. Even Nifty 50 earnings less than 2 peg, even if you believe 11-12% sort of earnings growth, 21-22 times, not very expensive. More so on account of the fact that even the mid and the small caps, particularly the small cap space, is in line with 3-year median valuations, 5-year median valuation. So saying that that space is still frothy, I wouldn't believe so. And earnings trajectory out there is going to be again 14-15%. So macros are improving, valuations are okay, volatility index seem to suggest that neither the bears nor the bulls are in a hurry to sell or buy. There's total complacency, and all of that would mean that, you would have a big trigger either on the upside or on the downside. Markets would wait with bated breath for next 3 months on account of the trade deal to get signed. And so that's how I would believe that the positives weigh more than the negatives.
So Manish, fair enough. Fair amount of factors on both sides, positive and negative. And I want to leave FPIs out of the equation for a bit. We'll come back to the FPI question. Let's talk about domestic flows, right? And that's what supported the market. Now, again, we work with an assumption that the SIP flows, the mutual fund flows will remain steady, and they have been. Between 25,000 crores on the downside in a bit of a weak month to about 35,000 crores in a good month. Now, assuming that remains steady, what is the rest of the local money doing? The so-called local smart money, the family offices, the HNI, the UHNI. Is that money fully deployed? Is there some waiting on the sidelines that could then propel the market higher? Is it going overseas because global markets are doing better? And you have a lot of options coming up in GIFT now, right? GIFT City, to invest in overseas markets. So what is the so-called local smart money doing?
So the very recent fancy for the UHNI family offices is gold and silver. So that has really caught the frenzy, and because markets have been very, sort of.
But Manish, that's not smart, na? Then they're chasing the price, much like how you say that new investors or novice investors do, simply chasing returns.
Whatever it is, they are chasing bullion.
Okay.
That is my observation. The unlisted portion has lost some of its sheen. We saw unlisted shares fancy in the last 2 years, but since the listing, many have listed at a discount to what the unlisted prices were quoting at. That has lost a bit of its shine. And, so it's unlisted, it's basically new IPOs, listing gains, and bullion, which is basically driving the markets for the UHNIs and that segment. Of course, out here, I would believe that because interest rates in the system are very, very low, this permanent shift from debt to equity is a given. And in time intervals, you'll see the movement between different asset classes. Currently, it is basically favoring bullion.
All right, take that point. Meanwhile, just, our team was alerting us on VIP. There was a large trade on VIP Industries, around 26% equity that changed hands. My sense is that this would be an inter-promoter or a promoter-related, deal itself, because no one else holds that kind of equity. And it may be perhaps an intra-promoter transfer where, maybe DGP Securities would perhaps give it to the multiples private equity guys. So we'll monitor how this pans out. But as of now, the stock has been a rank underperformer below the deal at which, the business was sold as well. So right now, post this last trade, we've seen a bit of a spike.
You remember that price, Manglam, off the top of your head?
Off the top of my head, no.
Okay.
I just checked that around. It was closer to, I think, where we are right now. Okay. After this up move that we've seen.
388.
388 was the price.
Stock hasn't really kind of taken off even after the multiples.
So,
and the deal happened in July of 2025. So 6 months in, the stock is where it is. And this is after the up move today.
Yep. That's after the up move. So which is why, the belief that it was an underperformer before this up move, and now it's pretty close to where it was. 388 is where it is. Manish, the travel and tourism space, and also the luggage space in particular. There's VIP, there's Safari in the listed end of things. Safari is obviously crossed VIP in sales, market share, and market cap by a long distance. But right now, what we're seeing is this is ripe for disruption from other new age brands as well. There's Mokobara. There is, at the upper end, Ethos has brought about some of the luxury brands here. what do you make of this space and many such which are ripe for disruption?
So we own VIP. So yeah, very positive on this space. Mind you, the luggage industry is a duopoly.
Yeah.
To say, maximum market, or let's say three players, Samsonite, Safari, and VIP, and the majority of the market share is basically by these three players. VIP got it wrong where they were late in moving to the online space, ceding market share to Safari. And Safari has really done well. Samsonite has been a laggard so far. They have today's news suggests that they are upping their capacity in Nasik by 7 lakh units per annum. But the luggage space is becoming very growth intensive. 6 lakh passengers traveling by air, around 1 million passengers traveling by road, 1 crore passengers traveling by train every day. And it's no longer just carrying luggage. It's more of a fashion statement. The Gen Z millennial will look at luggage also to be changed during time intervals, not the usual 10, 15 year. Now it is replaceable every 3 to 4 years. Now, having said that, 1.4 billion people in India have that recall value of VIP. Everybody understands VIP. So I think with the change in the management, their undoing of the previous strategies, following a consumer-centric, moving to online. Last quarter, they had a kitchen sinking quarter whereby they basically loaded all the expenses and the write-offs. That is why we saw the stock dip below 388, which was the open offer price. But at this market cap, and given the fact that it's only a matter of time when they could claw back their market share. And mind you, the unbranded guy, the D2C guys, this is a category which requires a lot of expenditure to build traction on top line. It's not a very easy category to penetrate. So yes, you may have newer brands come through to find top line, but it's a loss-making proposition for a very long period. So how many of them would survive really is the key. But on the whole, I think there is value in VIP, even at these levels, albeit Safari is doing very well in the current circumstances. They'll also do well. So quite positive on the luggage space as a whole.
Manish, what about Shriram Finance? 6th consecutive day of gains now, and the stock is trading well above the deal price of 840. Where does it go from here? Are you positive at this level?
Shriram Finance, the valuation difference between Chola and Shriram is quite big even now. I think we own Shriram Finance, and I think the cost of funds will come in lower because 40,000 crores worth of capital infusion will definitely reduce cost of capital, and their funding costs are going to come down. They'll apply for a rating upgrade, and they will have better leverage on the volume front. And the valuation difference between entrance players like Chola Mandalam seem to suggest that there's even more upside from the current.
So Manish, to sum it up, if I were to ask you your top 3 themes for 2026, what would they be?
So I would believe that discretionary consumption, and more so premium end of the discretionary consumption. And mind you, out here, one little insight is that brand salience today is getting diminished, except for 4 categories, which is basically automobiles, jewelry, real estate, and one more. So all these sectors would have salience on the brand salience, but others like consumer durables, etc., are losing their relevance on the brand sanctity. So out here, premium end is where we'll be focusing on. Capital market as a theme looks very, very entrenched even going into the next year. And rate sensitives as a whole, currently automobiles is leading from the front, but other rate sensitives like banks, insurance, real estate, they will also continue to do well.
Okay, so you're saying discretionary consumption, more the premium end, the rate
Capital
sensitives and capital markets. So there's a fair amount of a financial mix out there.
No, I just wanted to know his thoughts on some of these new age players. We've had, Lenskart, Meesho, Physicswala, all these. There was an initiating coverage coming in on Nykaa the other day as well. Eternal, quick commerce, always in focus. So what's your thought on this entire space?
So I was fortunate enough to buy into, let's say, Pine Labs and Grow on the first day. These are very good companies, according to me. You could have technical factors of float adjustment in these initial days of listing, but I think the growth in grow is likely to be 35-40% for the next 2 years, according to me. A 2,000 crore net profit this year translating and going forward into the next year, maybe a 3,000 crore profit on the back of a 15% top line growth. Half of that coming from subscriber addition, half of them coming from ARPU increase. That should give us a massive operating leverage translating into 3,000 crores of PAT. And going into the next year, around 4,000 crores of PAT. So around 35-40% CAGR growth rate in profits with a very high very high ROEs. And mind you, the profit growth is going to get channelized into building businesses like distribution, margin trading, and all of that. So I think 26% market share in active trading accounts on BSE and NSE, and the turnovers are only going to grow over a period of time. These guys have an entrenched moat. The tech capabilities, because these are ex-Flipkart guys, they understand technology much better than the phygital brokers, and that would give them the UI UX interface advantage, ease of navigating through the apps. That stands as a competitive advantage. Pine Labs, again, is a play on upscaling of consumption. It's a payment aggregator, of course, straddling both online and offline, moving into international markets, and out here also is a growth parameter because margin expansion due to high operating leverage looks good, and trading at a valuation discount to peers, Zaggle or Paytm, etc. So these are the two names that we own. Others, I don't find the valuations very lucrative, but some of these businesses are good, but valuation may be the only hindrance. But many more companies in the new age area is going to come for IPO in calendar 26. We'll keep a tab on them and evaluate.
Okay, so Pine Labs and Grow, two of the new age listings that have met the mark for Manish. Thanks for that. Manish, before we let you go, last 10 seconds on the conversation. Some of the poster child or the poster boy, poster girl sectors of the market, they seem to be under a cloud as we're closing this year, and EMS probably tops that list. There's a big debate on EMS now. Some feel that after a big correction, 25-30% correction, the stocks are again looking good. Some feel that maybe still overvalued and it's too closely linked to PLI and whether you have PLI or don't have PLI. Where do you stand in the great EMS debate?
So some of these players have run up quite a bit and probably discounting FY28, FY29 numbers. Currently, the apprehension is that rupee depreciation is going to hurt margins quite a bit. And that would be the key monitorable, because these are low margin businesses. They have a lot of volume, visible volumes come through. That is not a problem. PLI is not a problem. Valuations are a problem on the back of margin concerns due to depreciation of the rupee, because imported raw material as a portion of your bill of materials is still quite high. So from that perspective, valuations may go out of sync. So that is the apprehension currently.
So you're not buying the dips in EMS? Okay. All right, Manish, we'll wrap it up on that note. Thank you so much for joining in. Great conversation as always. Let's also take this opportunity of wishing you a very, very Merry Christmas, a very Happy New Year. May it be positive for you, your teams, your family in every way. Thank you for joining.
Very happy Christmas to you and CNBC and all your viewers, Surabhi.
Thank you. Thank you so much. Have a great day. Okay, speaking of a great day, one stock that's having a great day is definitely Coal India. Let's pull it up back on the screen. The rest of the market is actually, even the Nifty's turned around. It's flipped 50 points up now. So there's some buying happening at lower levels. And it's inching higher, 26,227, 228. So we're practically 100 points away from the all-time high milestone. 26,325 was the previous all-time high. I'm just about 100 points away from that. Let's look at Coal India, 2.5 up. Sud had alerted that, their whole plan of listing more of their subsidiaries, that seems to be rolling along. And Sudarshan, the market is taking note of that. So let's revisit the news.
So it's the top Nifty gainer for second straight day, and the reason on expectation of the listing that company is planning for its 4 subsidiaries in FY27. It had already begun the process to list 2 subsidiaries, and names are BCCL and CMPDIL. Now the latest update is that Coal Ministry on 16th of December had asked Coal India to begin the process to list other 2 subsidiaries, and those are Southeast Coalfields and Mahanadi Coalfields. Both these companies are, one is is in Chhattisgarh and one is in Odisha. And remember, the listing of these two subsidiaries would be very important as these two companies together form more than 50% of Coal India's production. And because of the listing, it can be seen as the major value unlocking as far as the Coal India is concerned. Now, what will be the next process? So yesterday, the board has given in principle approval for the listing of these two subsidiaries. Now, Coal India will take this process to Coal Ministry, and after their submission will be made to DIPAM, and following that all the regulatory approvals will be needed for the listing. But the expectation is that all these four subsidiaries will be listed in the upcoming fiscal, that is FY27, and on the back of that we are seeing a big move in the stock for the last two trading sessions.
A big move indeed. Look at JBM Auto. That's another one which has moved higher, up around 9%. And VIP, something that we just spoke about, up around 8% post that block deal. It's crossed or closer to the 394 mark. What we understand is that the stake, obviously, which was held under the promoter's name, which was controlled by multiples. Now, maybe multiples wants that in their books, so which is why we saw that bit of a intra-promoter sort of transfer that took place. The street is taking note of the fact that the stock has done nothing. And with the new owners, can they breathe fresh life into VIP or not? Hindustan Copper, another one where we spoke about, the silver prices doing well and commodities doing well. Zinc and Hindustan Copper, both of them have spiked. Hindustan Copper 5.5%, Zinc around 3% as well. Nuvama Wealth is the other one. I think 361 was one of the calls that came in from Sudarshan Sukhani, and Nuvama Wealth is another one which is doing well, up around 3%. But so you also have Pine Labs with you.
So it's another day, another positive brokerage note for Pine Labs. It's the recently listed company. Just last month this got listed. It was a strong listing for Pine Labs and stock has been moving higher. And today Jefferies has initiated coverage with a buy call, and target has given is of rupees 300 per share. Yesterday there was a positive note for Morgan Stanley, which had a target price of almost 260 per share. The stock is moving higher today as well. It's up currently more than 4%. Jefferies says company is a leading digital payments at stores as well as the prepaid cards, and building a share in the online payments as well as the international issuing business. Network with brands, merchants and banks with tech platform is the key mode for Pine Labs, and it can achieve 23% CAGR in revenue over FY25-28. Even operating efficiency can lift adjusted EBITDA margin from 15% to 27% that Jefferies believes that company can achieve over the next 3 fiscal, that is by FY28. And valuations are a discount to peers and can re-rate if company delivers the consistent growth that it has been seeing over the last few financial years.
All right, Sudarshan, thanks a lot for that. That's about Pine Labs, up around 4% right now. But the other stock on our radar, Aadhar Housing Finance. Next management on the show, stock surged more than 13% in 2025 so far. Expects strong AUM and disbursement growth as well. We're now joined by Rishi Anand, who's the MD and CEO of the company. Obviously, will the AUM cross 30,000 crore in FY26 with the third quarter disbursement trends and spreads with regards to their business, the net interest margin, will that expand or not? Would be some important points that we would be speaking with the management on. Thanks a lot for joining in. Rishi, season's greetings first to you, your team. If you could give us a sense on how the third quarter disbursements have been. When you joined us after your second quarter results, you said that the second half of this year could see 18% disbursement growth. Do you think that would happen? Are you on track?
Morning, Mangalam. Morning to you, Surabhi and Rima too. Yes, season greetings to all of you. Yes, I remember, speaking to all of you on our disbursement trends and H2 being much better than H1. Are we on track? If I were to answer that question, I would say yes, we are on track. And as always I've been indicating that for the current financial year, we will be looking at an AUM growth of anywhere between 20 to 22%. So disbursement will translate to AUM, and we are completely on track.
What were the October, Rishi, hi, morning, Rima here. What were the October and November disbursements run rate? Because in H2, to get to that full year guidance of 18%, you need to do about 23, 24%. So at least for October, November, can you share the disbursements run rate?
While I can't give you the exact numbers, Rima, you understand why, and good morning to you. But are we on track upward of 20% on incremental disbursements? Yes, we are.
Okay, so incremental disbursements in excess of 20% from the start of Q3. What about the cost of funds? The RBI has delivered an incremental 25 basis points of rate cut in the December meeting. Have you passed on? What's been the extent that you've passed on so far? And what is your cost of fund as we speak now? And you'd spoken about an exit rate of 7.75, 7.8%. Is there going to be a change to that given the rate cuts?
Yes, Rimas. The way it works is for the calendar year in question, total of 125 basis points repo cut has happened. Now, if I look at the way our borrowing is tagged, close to about 20% of our total 18,000 crore borrowing is linked to repo rate. The balance is linked to MCLR. So have we got an impact on repo rate borrowing, which is 20% of my borrowing? Yes, we have. The balance is yet creeping in very slowly on the MCLR borrowings. As we move ahead, the moment we get substantial impact on the cough, that's when it's going to be passed on to the consumers. The way we look at it, by end of Q3 sometime, the pass on should happen to the consumer. As regards our cost of funds, incrementally, you are right. We are looking at closing the year at about 7.75%. As we stand today, we are at a 7.8% cough.
Hi, Rishi. Morning. Great to have you in. Season's greetings.
Morning, Survi. Season greetings to you too.
I have a very different question. I'll get to that in just a second. Let me just complete Rima's point on, just with the way margins and spreads will move. I think last time we spoke after Q2, you had indicated that a range of about 5.75 to 5.8% should be expected in this year, I believe, for spreads. Is that pretty much where you are at now?
So Survi, right now, as we speak, H1 exit has been at 5.9% spreads. Okay. I don't see too much of contraction happening. So a 7.75, 7.8% is the right number to go with.
Okay. All right. Got that. Now, Rishi, the thing is that I think Christmas came very early for the NBFC sector. And Santa is coming in from all directions, from Japan, from West Asia. Yeah. You know what I'm getting at, right? I mean, checks are being cut for $3 billion, $4 billion. So how are you viewing the landscape? And I mean, I don't think that you've spoken about this in the past, but because Indian NBFCs seem to be looking so attractive to these foreign investors, I mean, are you beginning to have some thoughts? And how do you view what's going on? It seems to be a great environment to raise fresh equity capital for Indian non-banks and banks.
That's right. And what better timing, Surbi? Yes, things are looking good. Whether it is Japan, whether it is Singapore, whether it is UK, we are seeing a herd of investors looking at interesting options within the NBFC space. As far as we are concerned, Surbi, I think we are kind of capitalized to the extent that for the next at least 2.5, 3 years, I don't think we are going to be needing any capital infusion. So are we looking at any capital infusion from the flux that is happening today? No. So it is already Christmas for us when we did our IPO.
Got it.
Okay. So at your current capital adequacy levels, and I'm not now talking only FY26 end. I mean, what is the next because you're saying you're well capitalized for the next 3 years.
That's right.
So what is the next 3-year growth runway that you're working with right now? Will it be 15%, 20%? What do you have in mind?
So growth run rate, we are looking at anywhere between 20 to 22% for the next 3 years. So we'll keep that trajectory up and running, which means we will effectively double our AUM in the next 3.5 years. The way to look at our business is, what kind of levers are we sitting on? Debt to equity. That's how we measure ourselves. We are today comfortably sitting at about 2.55%. I think the capital requirement is going to be when we hit a 4.5, close to 5% lever. And that's 3.5, 4 years away.
Right. But, capital gets you the best value when you don't need it. That's when people are chasing you as against you chasing people. Let's see whether that happens or not if the check is tempting enough. But what I also wanted to understand is the underlying demand for housing by and large, because we, will view that from your lens right now. There has been both monetary, fiscal easing, the GST cuts, all of that has happened with people, having a little more money in their hands. Is that going towards consumption? Are we seeing any sort of increased demand for housing?
Okay, so Mangalam, the way to look at it is, the moment GST cuts were announced, I think the entire industry pounced on, is something more being left in consumers' pocket. It doesn't work like this. It takes a couple of quarters for things to move on. More than GST cuts, we had income tax benefits flowing in this year. Yeah. We had PMAY 2.0 announced. So there are, and the larger piece was the Swami 2.0 fund announced, which was 10,000 crores. 3 crore additional housing coming under the affordable housing projects. So these are substantial things that are happening by both central and state government. The regulator NHB, the supervisor NHB, the regulator RBI are playing their own bit. So there is little too much happening both on supply and demand side, and I don't see any reason why things should slow down or there is no demand. Yes, we all as an industry became a little cautious when the tariff issues came around, primarily on three sectors. But it hardly, and as we look at it on hindsight, there was hardly any impact.
So demand's good. I'm not talking about demand slowing down. I'm more looking at demand accelerating.
That's right.
Has that happened?
I meant that. Even I meant that. And yes, the only difference yesterday we were at Lucknow. The entire housing finance fraternity was in Lucknow. Our supervisor NHB had organized a CEO's conference, and we happened to meet some of UP's secretaries at the housing department, and we could figure out the kind of development that is happening. 60,000 plus affordable housing units up and running and available for grab by end users. Similar is the state in Uttarakhand, similar is the state in Karnataka, similar is the state in Andhra Pradesh, Telangana. So there is the demand, and we can see the demand coming in. These are actual end users who've taken the units, and they're looking for facilities now.
Got that. That explains why you're confident about a 22% growth runway for the next 3 years, which will double your AUM. Rishi, any pockets of stress seen in the industry in Q3? Because earlier there were regions in Kerala, East India, Calcutta, etc., where there was some stress. Not you in particular, but generally, how has the asset quality been? Are there any pockets of stress? And what is your guidance on cross NPAs for your company?
Okay, so I'll take the second question first, Rima. The guidance on GNPAs for the year as we end will be anywhere between 1.15% to 1.1%. That's what we've been delivering for the last 3 years, and I don't see any reason why the numbers should go up. We are stacking in perfectly okay. That also answers your first part of the question: is are we seeing any activities across multiple states which should be of any worry sign? No. The trend has been, if I were to pick up the last 5-year trend, whether it is you spoke about East, you spoke about Kerala, the trends have been similar. The consumer behavior has been similar. The good part is that we've started getting a lot of legal support from the judiciary. That's what helps us a lot.
All right. And what about competition coming from the PSUs? Because while we're worried about money from other parts of the world coming in and that causing some sort of competition in the space, the PSU competitiveness has picked up as well. I mean, 2 or 3 of the HFCs did speak about it in their second quarter earnings too.
Yes, Mangalam, you're right. It depends on what kind of HFCs you're talking about. But the moment it comes to low-income housing, that's the sector I cater to. The good part is, everybody's created their own niche, whether it is public sector banks, private sector banks, larger HFCs, and people like us who operate in the low-income space. We do something called non-income based lending, cash flow based lending. That's where I think we have a niche over all the public sector banks or the larger private sector banks. Do public sector banks want to get into cash flow based lending? I don't think they're going to be getting there in a fizzy or a hurry. Do they still need these kind of consumers? Yes, they would need these kind of consumers on their books to comply with the priority sector norms. And that's the route that they take is something called direct assignment from people like us. So are we seeing any real competition from public sector banks? I will not term it as competition. I think it is all healthy, but there is definitely an overlap of 3-4%. But that's about it.
Okay, so it doesn't seem to be of a magnitude that is concerning you as of now. You seem on track, sounding as confident as ever. 20% plus growth expected this year and maybe the next coming 2-3 years as well. Rishi, pleasure having you on the show today. Thank you so much for joining in. And once again, wish you a fabulous end to the year. Happy Christmas and a very, very happy 26.
Merry Christmas and Happy New Year to all of you and all your viewers, please.
Thank you. Thank you so much.
Bye-bye.
Have a great day. Bye-bye. Well, we'll take a quick break on that note. Coming up on the other side, we've been talking equities as of now. Need to look at the bond market as well because the RBI has announced a big bazooka move. OMOs worth 2 lakh crore rupees and a very, very large FX swap as well. What does this mean for the bond and the currency market? We'll ask Lakshmi Iyer for Bajaj Alternate Investment Management. Also with us will be Dhaval Dalal of Edelweiss AMC. Welcome back. You're putting the spotlight on the money markets now. The Reserve Bank of India has unveiled a fresh set of liquidity measures. It has announced a 2 lakh crore rupee additional OMO bond purchases and a $10 billion USD INR foreign exchange swap line. We have with us Lakshmi Iyer, Group President, Investments and CEO at Bajaj Alternate Investment Management, and Dhaval Dalal, President and CIO, Fixed Income at Edelweiss AMC. Ladies and gentlemen, thank you so much for joining in. Season's greetings to both of you. So it seems that the news headlines are not abating, even though holiday season is setting in. Let's get your sense, because, I mean, while in the policy, the RBI did indicate, but I think in the policy, Lakshmi, they announced OMOs worth about 1 lakh crore. Yesterday, what we got is 2 lakh crores, and it's coming in bam, bam, bam. I mean, throughout, January. Is it because the market was getting tight? There's been a lot of talk about how there is a lot of supply. There's a lot of, state debt that's being sold in the market. Your first thoughts?
Yeah, hi, good morning, Surbhi. So definitely the bond markets were actually behaving like Ranveer Singh in Durandar. They were they actually behaved
Rising
like
and rising, yeah?
No, they were actually living the moment ghayal hu isliye ghatak hu. So I think,
Wow.
they were wounded and therefore they were behaving lethal. And enter Santa Claus, or should I say Mr. Sanjay Claus, where he just opens up the bag and hydrates the bond markets, which was so much needed, because two parts to it. To your question, the bond markets were rising relentlessly in terms of yields because there was an inherent demand and supply mismatch. Point number one. Point number two is even the durable liquidity in the system was getting a little bit challenging. And given that the CRR as a tool has already been invoked, there needed to be another primary infuser of liquidity, which is the OMO and the swap. And of course, it does have the intent of cooling off the yields, which almost, I would say, flirted with 6.7 levels as of yesterday. And then we saw cooling off. So I think it is much intended, cooling off required in an era of climate change. This is a much welcome move.
Some mood today. There's Durandar, there's Sanjay Claus, and then there's climate change cooling off. Let's see whether Dhaval also, resonates with that sentiment as well. Dhaval, with the kind of cool off that we've seen, a slight one, where do you see these levels settle and, maybe move from here on?
So obviously, Lakshmi's legendary comparison notwithstanding, I think the bond market has been a little soggy, if I may use the word. And it's like probably the probable uncle who's unhappy with the wedding. RBI pumping so much of liquidity in the last month. I think the bond yields continue to trend higher, presumably because the Reserve Bank of India did not announce any OMO for the January. And I think also the higher than expected SDL auction, I think that was these are the two triggers which pushed the bond yields higher in the first in Monday and Tuesday as well. So I think in response to that, the Reserve Bank of India has come out with a very big bazooka OMO bond purchase and a $10 billion swap. I believe that this should calm down some of the nerves in the bond market who has been asking for more and more. And I think this is a very, very good level of injection. I think from 1.5 trillion to additional 3 trillion. This should be sufficient, in my view, from the bond market's perspective to stabilize the bond yields and bring them lower to a fair value. I think in the last couple of months, we have seen the yield curve experiencing a little bit of bear flattening, where the short-term yields have trended higher, particularly 5 to 7 year segment has been the biggest hit, and while the long-term yields have actually trended lower. So I think some amount of respite is needed at the short end.
Sure. Both of you are on a roll, right?
Someone told me on the 24th at 9:50 you'd be discussing bonds, and suddenly someone spoke about Durandar, Uncle at the wedding, Santa Claus, and Ghatak, Ghayal.
So
all those things, I
think it's very, very colorful. Maybe I can add on. It's rubbing off on me as well. So that uncle, we'll call him Uncle Scrooge, Dhaval. So that's how the bond market was behaving, not getting into Christmas festive spirit. But then Sanjay Claus stepped in. I must apologize at the outset.
Grinch.
In case anyone from the RBI is watching, this isn't just, this isn't jest, it's holiday spirit. So please excuse us.
I think we should change it to Grinch, right? Because it's the Christmas season. So that is the really grouchy person.
But, just to complete that point, and, I leave it to either of you to take it up. So a couple of factors which were leading to these higher yields, right? The higher supply, the SDL auctions, like you mentioned. I want to understand to what extent was this unprecedented rupee fall and whatever little the RBI was doing to support. It wasn't doing much, but some sales were happening in the market. Did that also exacerbate the position? And during that time, there was some chatter about whether FPIs will start selling in the debt market as well. They're anyway selling in equity. So there was some fear around that. So where are we on the whole rupee front and the rupee bond tango then? Lakshmi, you want to take that?
Yeah, so Surbi, if you look at the month of December, the FPIs have actually net sold even in fixed income. Up until now, they've sold about 12,500 crores. Of course, for the entire year, we'll be closing in closer to about 56,000 odd crores, 1,000 crores positive. The rupee depreciation and the resultant intervention also exaggerated the liquidity deficit in the system. So as of this early start of the week, we were in a marginal deficit. And I think that's where the governor has played true to what he mentioned in the policy, that they will ensure that the liquidity in the system is not hampered. And with this announcement of the swap, INR swap, we are coming back into the region of plus minus that 1% of NDTL or net demand and time liabilities. Is it that the rupee depreciation is leading to a spike in yields? That's not clearly the establishment, but of course liquidity was definitely a challenge, and I think that has got addressed to.
Okay. Lakshmi, what would be the impact on the 10-year bond yield? Where does it settle, assuming there are no more shocks or surprises that come in, based on this announcement? And then even, say, over the next 3 months, FY26, the end of fiscal year 26?
So, Rima, our view is clear that this is a good and a very positive move, much intended to bring some cooling off on the yields. You could see yields receding towards the 6.5% region, but incrementally, will banks continue to support? See, they've been tendering in OMOs. Have they been really buying in auctions? I think all of that will set the narrative for it to decisively breach the 6.5 level on the lower side and stay there. So I think there are going to be multiple and our view is that this may not be the last of the measures. So I think bond yields are going to be in check, maybe closer to 6.45, 6.5 lower end, higher end of 6.65. I think the lid for the bond yields have been done for now, unless some other bazooka unfolds.
All right.
More measures are expected, according to Lakshmi, to keep the yields in check.
Let's see whether that happens or not. Just a word on the correlation between the way the rupee weakened and the impact of the bond on that. Now we've seen the dollar weakness obviously come by over the last few sessions. So that's stabilized the rupee a little bit. Where does that go from here?
So our analysis shows that there is a correlation through the cash term rates. And what we have observed that during the swap days, first swap of $5 billion, we saw the cash term rates moving all the way up to 7.5% to 9% in some days. And as a result of that, we saw banks taking advantage of the higher cash term rates and try to issue bank CDs in a higher quantum in month of December. And that has resulted in slightly higher short-term rates. We also saw some redemptions in the system that all has contributed to some amount of selling from mutual funds in GSEC as well as in corporate bond market, and that has pushed rates higher at the short end. So these are the confluence of factors which has resulted in some amount of higher yield in corporate bond and GSEC. And now in January, Feb, March quarter, we have to see how much of the SDL supply comes in, because that's the one last bridge to cross as far as bond market is concerned. If SDL supply is lower than feared, then I'm sure that the 10-year will clearly go below 6.5.
Having
Finally.
by the way, a positive rub-off on many of the NBFCs.
So NBFCs are doing very well.
Very well. If you look at the top two Nifty gainers, it's Bajaj Finance and Shriram Finance. And outside of that, you've got a Manappuram Finance, of course, aided by the record surge in gold prices. But in M&M Financial, also up and about, L&T Finance, Poonawalla, Sammaan Capital, Edelweiss Financial. Across the board, I think that is a sector which is leading today. And it's aided by the moves and the announcements seen by, in the bond market by the RBI.
Absolutely. Who says there was no green in the Indian equity market? Just look at what happened to these financials and particularly in some of these NBFC stocks. What a move on them this year. And it's continuing as we wind up the year as well. Final question to both of you. So the other issue for the market, will the RBI cut or not cut? Are we done with rate cuts? Where do you stand on that? Outlook 2026, Lakshmi?
I'd say that the incremental scope of significant easing from here is not there. So we would probably push our luck and max maybe see one more rate cut. But beyond that looks very, very difficult. And timing, I don't think it's a slam dunk that we'll see it in Feb.
All right.
And Dhaval, quick 10 seconds, your call.
See, our view is that inflation is likely to surprise us on a lower side. So the RBI will have a room to cut. But whether they cut or not, it's immaterial. I think the 10-year will clearly go below 6/4 in 2026.
All right, gentlemen, take that call. As we speak, we're speaking about the festive season. A couple of stocks that, deserve mention. Sula has been, again, a rank underperformer. Sula has been down, 44-45% this year. A big cut from its post-IPO price as well. Currently seeing a gain of almost 7.5%, maybe the season of mulled wine this time. But the other one is VIP, as sources tell us that, the entire deal with multiples is complete right now. Remember, the deal was struck. Multiples was to buy 32% stake of the company at 188 rupees per share. The Piramal family has earlier transferred about 6% stake, and with today's 26% stake, 32% stake from the Piramals transferred to multiples, and that stock up around 5.5%, hasn't moved much from the price at which the deal was struck. But good time to get in a technical view on the market. Nagaraj Shetty of HDFC Securities joins us now. Nagaraj, your thoughts on the indices? We've recovered a fair bit from the lows. Where do we go from here?
Hi, good morning. Market has been a strong uptrend, no doubt about that, after a sharp up move recently, showing some sign of consolidation. Technically, this consolidation more often leads to a uptrend continuation pattern, and I'm believing that to true this time also. And market is likely to move further. At the higher levels, 26,300 to 400 is likely to offer some resistance for the market, and eventually Nifty could reach towards the 26,600, which is the initial near-term target for the market. Second, stocks, I have two stocks, one UPL and NMDC. UPL chartically was moving in a larger consolidation band and recently witnessed a decisive upside breakout of around 770, 780 levels, currently trading higher. Overall chart pattern is looking positive, and RSI and volume breakout is also seen on the charts. So currently trading around 780, one can look to buy at this point of time. Initial target would be around 820, and one can place a stop loss at 760. Second one is from a metal front, NMDC. NMDC was moving in a larger range-bound action over the last few months and before witnessing a sharp breakout in last two sessions. And the overall chart pattern is indicating the sharp upside momentum is on the way. The rise in volumes during breakout is indicating more upside could be there in the near term. Currently trading around 81.48, 81.50. One can look to buy at this point of time. Immediate target would be around 86. One can place a stop loss at 79.
Thank you very much for joining in. Let's talk about some stocks which are moving around smartly. Ajanta Pharma right on top, 4% gain. Ekta is here to tell us the news. Ekta.
Well, yes, Ajanta Pharma is in focus because there is an important deal which they have struck. They have signed an in-licensing agreement with Biocon. This is for marketing semaglutide, which is basically the generic molecule of Wegovy as well as Ozempic, which is the weight loss drug by Novo Nordisk and which is going off patent in multiple countries come next year. That includes Canada in January as well as emerging markets, including India, in March of 2026. So this particular licensing agreement is with Biocon for around 26 countries, and it is exclusively across most of them and semi-exclusively in 3 geographies. It is across Africa, the Middle East and Central Asia. Now, the patent, like I mentioned, expires in most of these markets in March of 2026. So, Ajanta Pharma plans to commercialize the products after receiving regulatory approvals, which they expect in late 2026 or early 2027. Remember that many such companies are looking to do such deals. We are probably going to hear a lot more of it as the patent expiry does come closer. So for this, Ajanta Pharma has a strong presence within the geographies such as Africa. So for them, it would be easier to market a drug such as semaglutide more extensively.
Thank you very much for that. Get into a break. On the other side, Manisha Gupta will join in to focus on commodities. Stay tuned. Welcome back. As promised, let's talk commodities. Manisha is now joining in, and Manisha can't stop talking about the rise in gold and silver.
Well, absolutely can't. And that's exactly what gold and silver are ensuring as well, with all-time highs continuing on to this one. I'll start with silver first, and we've seen an all-time high of $72.7 an ounce for this one. Now, if you look at the overall this year gains, that stands at 151%. So it's more than doubled is how we look at the silver prices. I want to take you through on what we've done through the year in sense of gains here. So we started this year with $29.5 an ounce. It was somewhere in June that we saw $30 pass and go up to 37 as well. $40 crossed in September, and then you saw $50 cross in October. Well, this is the first time that $50 was hit since 2011, and $50 was an initial all-time high as well. $60 and $70 got done in the month of December itself, and we're not even done with the whole month right now. So from where we're standing right now, it has been a 40% of gain in case of silver prices in last 1 month itself. For the Indian prices, we've crossed above 2,20,000 rupees a kg right now, with strong support continuing from the ETF buying for the Indian markets, and the international markets have seen 4,000 tons of holdings for ETFs therein. It has to do with the strong industrial demand. The conservative demand continues to be there, the conventional that is. And then apart from that, you have the AIs and the data centers and EVs and green energy, and silver is getting used in all of that. And then this is about disruption in case of, or dislocation rather, in the international markets. So a lot of LME inventories have continued to decline because a lot of silver is getting shipped to US, and then ETF demand is that is where silver is getting logged as well, weighing onto the prices there. Hedge funds were caught short, and we have seen them coming back into the markets as well. There is a deficit that continues because mine supply in last 10 years has declined around 80 million ounces. So 1 billion ounce of a supply is what we are looking at in this year. Apart from that, markets also believe that some bit of a crypto money also seems to be coming into the markets. Silver is part of the US critical mineral list as well. So everywhere that you look, there is no reason to go short. There could be some profit taking because people are holding silver, but no shorts absolutely coming in for this sector there. Not just silver, gold is trading at an all-time highs as well, $4,525 an ounce onto this one. And for this year, we are up by nearly 72% into the markets there. Take a look at the chart on how gold has performed in this year. We started this year with 2950, 3000 got taken off in the month of March, an all-time high of 3500 in September. 4,000 is what we saw in October. Now, this is a string of all-time highs that gold also continued to do, and 45.25 is what we're looking at this point in time. So the last $500 of a jump up clearly came in the last 45 days itself. For gold also, this is the strongest annual gain since 1979. It has been 51 record highs that gold has done in this year. And then Indian gold prices have surpassed above 1,38,000 onto this one. A lot of geopolitical tensions because you have US, Venezuela, Iran, Israel, and that it also is about Russia, Ukraine. All of that have been quite supportive. It also has to do with a very strong central bank buying that we have seen, investment, institutional buying, portfolio diversification. All of that led to strong gains coming in for gold. And then the rate cut expectations going forward have been supportive. And finally, I want to talk about platinum prices, and they have outperformed gold and silver as well. $2,385 an ounce onto this one. And we've seen 163% of gains on for this one for this year. This chart should come in on your screens as well. And this is going to be very, very surprising because we started this year with sub $1,000 an ounce. So we were trading at around $910 in the month of January. And then we've seen $1,000 cross in May, 1,500 cross by September, and 2,385 of an all-time high standing in December. I mean, this is something you see perhaps in once in a lifetime, the kind of run-up that we've seen. 170% of gains come in. So tight supply conditions, strong investment demand, inventories continuing to decline. This is a third straight year of deficit as well. European Union demand is expected strong. Chinese platinum demand has been very, very strong. So if you look at the China platinum bar and coin purchases, that stands at 418,000 ounces. You know, interestingly, China has not bought any diamonds this year. They have bought gold, silver and platinum, and it clearly shows. And the launch of platinum futures in Shanghai Exchange is yet another thing. So people are buying it in physical, in futures, everywhere. So China clearly buying a lot of this, and so is India.
All right, when China buys, we see a big price move, and when India buys as well, we see a big price move. All the money from diamonds perhaps going into platinum, gold and silver. With all the financialization of these assets, a big move is what we're seeing. Thank you, Manisha, as always, for telling us what's taking place out there. Just monitor Grow. That stock has been doing extremely well. Just the last few minutes or so, it's seen a massive spike up around 7%. There have been a couple of brokerage initiations on this stock over the last two sessions. The one that came yesterday was actually a sell report that came in. So the stock obviously, is mildly off its post-listing high, but seen a big move in the last 7 days itself, up over 21%. 361 WAM as well, which was one of the technical calls at 10, has seen a bit of a spike. That stock's moved higher, and we continue to see some traction in a lot of these NBFCs, which continues from the word go. Manappuram Finance for now up around 5.5%. What we'll do is take a short break, come back on the other side. A special discussion on REITs with Vinod Rohira of K. Raheja Corp and Ghulam Zia of Knight Frank. Welcome back. Now, let's talk about the REIT space because it was one of the most notable trends in 2025. The increased focus on real estate investment trusts, also known as REITs, or basically, making real estate investment acceptable or agreeable or palatable for small ticket sizes as well. India saw its 5th REIT list on the stock exchanges. The market cap now stands at around $18 billion. So to discuss this space and the landscape, joining us now, Vinod Rohira, MD and CEO at K. Raheja Corp. We'll also have Ghulam Zia join us shortly. Thanks a lot, Mr. Raheja, for joining in, Mr. Rohira for joining in. On the REIT space itself, 2025 has seen a lot of regulatory changes, some more expected in 2026. What else can be done for you to make, from your side and from the regulator side, for REITs to be a little more attractive?
Hi, thanks for having me on your show. Good morning and wishing you a Merry Christmas in advance. So I look after in my role on the development part of the business, which is residential and commercial real estate. I can tell you that the markets finally are understanding the intrinsic value of the capital value behind the annuity of assets like grade A commercial real estate, and which is the reason why you're seeing the interest in REITs going up. And of course, SEBI has helped understand the investor that this is more of an equity instrument than just a debt instrument, and it's got a long-term value to it. And it's an intrinsic value-driven asset, which is focused on dividend and total growth. So all of these aspects are now penetrating deeper, and you're seeing much larger interest in having a share in investing in commercial real estate. I think this is only going to keep going up because it's going to be far more stabler as an instrument, far more accepted as an instrument, and it'll do phenomenally well in the years to come.
So for K. Raheja Corp, between commercial, which is similar to REITs, the annuity kind of a business, versus the pure residential space, I mean, what is the current breakup? In 2025, what have been the kind of returns that you've generated from both these assets? And will you be shifting more towards commercial then?
I think we are set to blaze guns in all of these directions. We see a lot of potential for grade A plus commercial real estate. We see a lot of potential for the most aspiring, aspirational luxury in every market segment, and we want to really scale that up. You will see us announcing a lot of projects that are on the drawing board getting started in the next few quarters. So we are very, very bullish on prime real estate for residential as well as commercial across all the prime markets in India. We've seen a great year, and I think 26 will even further be a strong endorsement to trust and brands that are delivering quality of a different level. You will see the consumer asking far more, and those who can stack up will actually do really well.
So what is the incremental addition seen in the industry this year in commercial versus residential?
I think the returns have been phenomenal in both cases. You've seen a huge demand from large institutions wanting to buy annuity assets, which was not the case up to 2 years ago. So any assets that coming out to sale, very few grade A plus assets are really available. And if they're available, they're being bidded at crazy prices because people want to acquire those assets which are already giving you annuity returns. So that you're seeing yield compressions take place, and you're seeing assets being appreciated if they are grade A plus plus. Similarly, if you see the consolidated space the commercial real estate has, the marketplace has very few reputed players who are developers and asset managers combined. And in that space, in grade A locations where you're building grade A plus plus, the demand is far outstripping supply. And that's really the advantage you see if you're really aggressively building, because the tenants you want to lease to are not happy with starter title. They don't want to see broken up assets. They want to see someone who they can call 24/7 to look after the experience and the asset. And if you have a combination of those going, you have a runway to be able to deliver quality assets and get the best tenants in. And we are seeing that runway play out in 25. You will see that play out in 26 as well. Similarly, for the residential play, the shift is towards quality, timely delivery, and a different level of experience you're offering. The consumer's changing, mind you. In the next 5-7 years, the seniors will start dictating what they want in their homes. You have to pre-plan those kind of assets and build them. And if you're right up there, you will see a massive demand surge because the client is willing to pay and wants a lifestyle.
All right, massive demand surge is what is expected from a consumer standpoint. But let's go back to the investment question. Ghulam Zia also with us right now. Ghulam, it's Christmas time. Everyone has their wish lists, right? So from a REITs investment standpoint, what would be on your wish list from the regulators for the next 1 year? What can make it a lot more attractive than what it is already?
Good morning, everybody. Good to be here sharing this space with Vinod. He is an expert on the subject. The point we have been wondering is, this market has to expand, with barely less than half a dozen of REITs. I would want to see this whole market expanding more. And that's where we wish to see at least 3-4 more REITs coming on the block, giving more options to investors to select from. And that's something which is actually in sync with where we stand as far as India is concerned. We have already crossed, as far as offices are concerned, more than 1 billion square feet of space is already with us, and we are going great guns. So this is high time we expand the portfolios, get more REITs out there, give more options. Obviously last year has given us a great investment opportunity for people. The growth has been fantastic. The returns have been outstanding. So we want to see it continuing and more options, more REITs to come on the block.
What is India's current penetration in terms of REIT in listing versus the globe? And what is the expected addition to REITs in the next 3 to 4 years, Ghulam? You speak to everyone in the industry. Where is the industry headed?
Well, the way we look at it, not even 20% of A-grade office stock is right now in the portfolio with REITs. So there's a huge runway. We have a huge opportunity ahead of us. So where we see it, even if it is only office market where it is doing exemplary performance, it's a great runway ahead of us. On the other side, whether it is retail or hospitality REITs are also coming up, and of course, warehousing also gets to be a part of infrastructure domain. So whether it is REITs or InvITs, I'm not too very clear, but then warehousing is also a huge domain. So as far as real estate connects are concerned directly, a lot of these options exist, and we do see in next 3 to 4 years, I would love to see at least half a dozen more REITs knocking coming around the block and giving more options for our investors to participate.
All right, we have 5 already, and you expect a half a dozen more to come by as well. Just a final question to Mr. Rohira. Mr. Rohira, you spoke about residential, you spoke about commercial. Let's speak about hospitality. That's another very attractive, opportunity for builders like yours.
Absolutely. So as a group, we are very clear on the drivers for growth. We see hospitality to grow tremendously in the right locations. And there's a separate team in Chalet that runs this, and they're constantly giving you feedback on what they see of the marketplace. As a group participant, I can tell you that there is a tremendous opportunity in hospitality, in retail, in prime residential, as well as commercial. And there are other asset classes that are emerging, which need scale, whether it's healthcare, whether it's education. All of these will play out dramatically in the coming 5 years, and you will see a lot of that deciding how value grows and how infrastructure plays out.
All right, gentlemen, thank you so much for joining in and giving us your perspective on real estate investments, the real estate trends, and the drivers for the growth of the sector. Let's see 2026 brings you the kind of returns in real estate stocks and real estate investment trusts as well as we speak. With that, out of time on this edition of Bazaar, we wrap up with the good news. The market is up almost 50 points for the Nifty. The Nifty Bank up around 125 points, with mid-caps far outpacing the frontline indices. The advances around 1700. Take a short break, come back. A team of chartbusters on the other side.